Have you ever stared at your tax forms and thought, there has to be a better way to lower my taxable income? You're definitely not alone. Many of us feel that way. And often one of the most powerful yet frequently misunderstood tools available is the itemized deduction. It's a key area where, small differences in understanding can lead to pretty significant savings. Today, we're diving deep into the world of itemized deductions. We're pulling from your sources on individual income taxes 2026, specifically Chapter 10. Our goal isn't just to tell you the rules, but to really cut through the complexity, highlight what truly matters, and maybe give you those aha moments that make you feel genuinely well-informed and, empowered about your finances.
That's right. While the general principle in tax law is that most personal expenses aren't deductible, largely to simplify things, and broaden the tax base, Congress has over time carved out very specific exceptions. So we're going to explore these key areas today. We'll cover medical expenses, various types of taxes, interest payments, and charitable contributions. And we'll also touch on a few other kind of nuanced deductions and, crucially, discuss some smart timing and planning strategies that can really make a difference for you.
Okay, let's start with medical expenses. This can be a substantial deduction, but there's a catch, right? A significant hurdle.
Yes, the 7.5% AGI floor. You can only deduct the amount that actually exceeds 7.5% of your adjusted gross income.
Right. Which means for a lot of people, unless they've had a really, catastrophic health event or just a year with unusually high medical costs, they might not even hit that threshold. It's quite a high bar.
It is a high bar, yeah. But what's crucial here, and maybe a bit surprising, is that the definition of medical care is actually pretty broad. It goes way beyond just a doctor's visit or a hospital stay. It covers anything for the diagnosis, cure, mitigation, treatment, or prevention of disease, or, anything that affects any structure or function of the body. So that opens the door to some expenses you might not typically think of.
Okay, so beyond the obvious, what are some of these surprising things that might actually qualify?
Well, for example, routine physicals and dental exams. They absolutely count, even if you're perfectly healthy. The IRS sees that as prevention.
Okay.
But on the flip side, purely cosmetic surgery, like, say, a facelift or hair transplant, just for looks, that's generally not deductible.
Okay, so there's a distinction. What if the cosmetic surgery isn't just for aesthetics? What if it's necessary?
Exactly. That's where the necessary distinction is key. If cosmetic surgery is done to improve a deformity, maybe from a congenital abnormality, a personal injury, or a disfiguring disease like reconstructive surgery after an accident, then it is deductible. It really boils down to medical necessity, not just an elective enhancement.
That makes a huge difference.
Okay.
And what about long-term care? Say, nursing home expenses.
Right. For a nursing home or a home for the aged, the costs, including meals and lodging, are deductible if the main reason for being there is medical care.
Okay.
If someone's there primarily for personal reasons, then only the specific medical or nursing care costs are deductible, not the room and board. And similarly, tuition at a special school for a dependent can be deductible. That includes meals and lodging if the school's main purpose is to help alleviate an infirmity through its special resources. It all kind of hinges on that primary medical purpose.
And sometimes medical needs go beyond just visits and pills. They require, changes to your home.
That's a great point. Capital expenditures, big purchases that are dictated by medical necessity can be deductible. We're talking about things like installing a dust elimination system for severe allergies, maybe an elevator if someone can't use stairs, or even modifying a van for a wheelchair. And what's really interesting, maybe surprising, is that these are deducted in the year you pay for them. They're not depreciated over time like other home improvements.
Wow. So, okay, if someone needs, say, a swimming pool for hydrotherapy and there's no community pool nearby, that could count.
Potentially, yes.
Or an air condition for a specific condition, as long as it's not like a permanent upgrade to the whole house.
Exactly. And there's actually a special rule for home-related capital expenditures for handicapped individuals. The increase in the home's value from the improvement, it's considered zero for deduction purposes.
Oh, okay.
Which means the full cost, not just the amount over any value increase, is subject only to that AGI floor. That's a real advantage.
Good to know. And it's also important to remember you're not just limited to your medical expenses, right?
Yeah.
You can include costs for a spouse and dependents.
Absolutely. And here's a detail that often gets missed. For medical expense deductions, the usual gross income or joint return tests for claiming someone as a dependent don't apply.
Ah,
So you might be able to claim medical expenses for someone who wouldn't normally qualify as your dependent for other tax purposes.
okay, here's a specific example that might help clarify. For divorced parents, a non-custodial parent can claim medical expenses they paid for their kids, right? Even if the other parent claims the child as a dependent.
Precisely. So if Fred pays, say, $2,500 of his daughter Cindy's medical bills, he can include that in his medical deduction, even if Cindy's mother, Marge, is the one claiming Cindy as a dependent on her return.
Gotcha. It's about who actually paid the bill.
Right. And when you're traveling for medical treatment, those transportation costs can really add up. And yeah, they are deductible. This includes bus, taxi, plane, ambulance fares. Even using your own car for 2025, the rate is around 21 cents per mile, plus tolls and parking fees.
Okay.
And you can even deduct transportation for someone traveling with the patient, like a parent or a nurse, if their presence is essential.
Now, lodging while traveling for medical care, that can be a big expense too. Does that count?
It can, yeah, but there are limits. You can deduct lodging away from home for medical care, but it's capped at $50 per night per person.
$50 a night. Oh.
Yeah, that covers both the patient and one traveling companion. And the rules are pretty strict. The lodging has to be primarily for and essential to the medical care. It has to be at a licensed facility. It can't be considered lavish. And there shouldn't be any significant element of personal pleasure involved.
Right, so no luxury spa retreats disguised as medical trips.
Exactly. And a key detail here, meals while traveling are generally not deductible. And no deduction for meals unless they're actually part of the medical care itself and provided at a medical facility.
Okay, so planning is definitely key there. What about medical insurance premiums? How do they fit in?
Generally, those premiums are just added in with your other medical expenses, so they're also subject to that same 7.5% AGI floor. Now, if your employer pays your premiums, that's not counted as part of your gross income and you can't deduct it either,
Right.
which, is effectively a tax benefit already.
But there's a different, better rule for self-employed folks, isn't there?
Absolutely. This is a huge one for small business owners, freelancers, independent contractors. Self-employed individuals can deduct 100% of their medical insurance premiums as a business expense. And this is a deduction for AGI, which is generally more valuable than an itemized deduction.
That's significant.
It is. The only catch is you can't be eligible for an employer-provided health plan somewhere else, like through a spouse's job. You can also include premiums paid for qualified long-term care insurance, though there are specific limits based on age. For 2025, those range from $480 up to $6,020, depending on how old you are.
It encourages planning,
Definitely. And then we have health savings accounts, HSAs. These have become really popular, especially with high deductible health plans. Contributions are deductions for AGI, right?
Yes, and HSAs are really powerful. To put into perspective, they offer this unique triple tax advantage that's hard to beat. Your contributions are deductible for AGI, the money grows tax-free inside the account, and withdrawals for qualified medical expenses are also completely tax-free.
Wow, triple benefit.
Yeah. Plus, they're portable. They go with you if you change jobs or retire. For 2025, the contribution limits are $4,300 for self-only coverage, $8,550 for family coverage. And there's an extra $1,000 catch-up contribution if you're age 55 or older. It's a fantastic way to save for future healthcare costs. Okay, great info on medical. Shifting gears now, let's talk about taxes. This is another area that causes a lot of confusion, especially telling the difference between a deductible tax and a non-deductible fee. For personal stuff, fees like, say, dog licenses, car inspections, road tolls, even postage stamps.
Right.
Those are not deductible as taxes.
Yeah, the key distinction to keep in mind is that a tax is generally a mandatory charge imposed by a government, federal, state, local for public purposes. Think funding schools, roads, general government operations. A fee, on the other hand, is typically a charge you pay for a specific service or privilege you receive directly. Like paying for a license gives you the privilege to own a dog, or an inspection fee pays for the inspection service.
Got it. Paying for something versus paying into the system. So knowing that, what taxes can you actually deduct?
Okay, the deductible list includes state, local, and foreign real property taxes, so taxes on your home or land. Also, state and local personal property taxes, but only if they're ad valorem, meaning based on the value of the property, not just its weight or size like some vehicle taxes. Then you have a choice. You can deduct either your state and local income taxes or your state and local sales and use taxes. You pick one.
Choose one. Okay.
And finally, foreign income taxes are also generally deductible.
All right. So what's definitely on the non-deductible list? What can't you claim?
Well, number one is federal income taxes. Can't deduct those.
Right.
Also, FICA taxes, that's Social Security and Medicare taxes withheld from your paycheck if you're an employee. Those aren't deductible. Estate taxes, inheritance taxes, gift taxes generally not deductible as itemized deductions, and various federal excise taxes like on gasoline or air travel.
Okay. Now, for many homeowners, especially in certain parts of the country, this next point is a really big deal. The SALT cap.
Absolutely. Putting this into context, from 2018 all the way through 2025, there's a limit on how much state and local tax you can deduct. The deduction for your combined state and local taxes, that includes property taxes plus either your income or sales taxes, is capped at a maximum of $10,000 per household per year.
$10,000 total.
$10,000 total. Or $5,000 if you're married but filing separately. And this cap applies specifically to taxes you deduct from your AGI as itemized deductions.
So the clear implication here is if your state income taxes plus your property taxes add up to, say, $15,000, you can only deduct $10,000. That extra $5,000 is lost as a deduction.
Exactly.
This hits taxpayers really hard in high-tax states like New York, New Jersey, California. It often means that itemizing doesn't make sense anymore for people who used to benefit, pushing them towards the standard deduction instead.
That's right. It significantly changed the calculation for many. However, there is a nuance worth mentioning, particularly for business owners. State income taxes paid at the entity level by partnerships or S corporations, sometimes called PTE, or pass-through entity taxes, can actually avoid this $10,000 cap for the individual owners. That's become a really important planning strategy.
Interesting workaround for business structures.
Yeah.
Okay, a few specifics on property taxes. What about assessments for things like new sidewalks or streets?
Good question. Assessments for local benefits like that, if they tend to increase the value of your property, are generally not deductible as taxes.
Okay.
Instead, you add that cost to the tax basis of your property. So it might reduce your capital gain when you eventually sell the house, but no immediate deduction.
Gotcha. And when you buy or sell a house mid-year, how do the property taxes get split?
The real property taxes for the entire year are basically apportioned or divided between the buyer and the seller based on the number of days each person owned the property during the real property tax year. It ensures fairness, you know.
Makes sense. Okay, and back to that choice between deducting state income taxes or state sales taxes. How does that work?
Right, you elect one or the other. For sales tax, if you haven't kept every single receipt, the IRS provides tables that estimate the amount you can deduct based on your income and state. Or if you have kept good records, you can deduct your actual sales tax payments. Plus, either way, you can add on the sales tax paid on certain big ticket items like cars, boats, RVs, things like that.
So you choose whichever gives you the bigger deduction.
Generally, yes. If you live in a state with no income tax, like Texas or Florida, or a very low income tax, taking the sales tax deduction often makes more sense.
Right. And what about timing? When do you deduct state income taxes?
Okay. For cash basis taxpayers, which is most individuals, state income taxes are deductible in the year you actually pay them. So this includes estimated tax payments you make during the year, or payments made with your state tax return filed the following year, or even taxes withheld from your paycheck.
Even if the payments relate to a different tax year?
Yes. It's based on when the cash goes out. But here's the flip side. If you get a refund later because you overpaid, you might have to include that refund amount back into your income in the year you receive it, but only to the extent that the original deduction actually gave you a tax benefit. It's called the tax benefit rule.
Okay. The IRS giveth and taketh away. All right, moving on to interest deductions. This is another area where people hope for savings, but the rules can be, well, tricky.
Very true.
Let's start with the big one. Personal consumer interest. Like on credit cards, personal loans, even car loans for personal use.
Yeah.
Generally not deductible, right?
That's correct. Generally no deduction for that kind of personal interest. It's considered a personal consumption expense.
So what kinds of interest are potentially deductible?
Okay, good news for students and maybe recent grads. Interest paid on qualified student loans is deductible.
That's helpful.
Yes, it's a deduction for AGI, which is great. There's an annual limit, though you can deduct up to $2,500 per year.
$2,500 max. Are there income limits?
Yes, there's a phase-out based on your modified adjusted gross income. MAGI. For 2025, that phase-out range starts at $85,000 for single filers and $170,000 for joint returns.
Yeah.
So higher earners might get a reduced deduction or none at all.
Okay.
And you also can't claim it if you're claimed as a dependent on someone else's return or if you're married filing separately.
Got it. Now, for homeowners,
Mm.
this is often where the biggest interest deduction comes in. Qualified residence interest.
Exactly. This is a really significant one for many taxpayers. Qualified residence interest is deductible, and it applies to interest on debt secured by your principal residence and one other residence you choose.
One other residence. So like a vacation home.
Could be a vacation home, yeah. Or, and this always gets a reaction, the definition of a residence is actually quite broad. It can include a house, obviously, a co-op condo, mobile home, or even a boat, believe it or not.
Wait, a boat? You're kidding?
Not kidding. As long as the boat has basic living accommodations, sleeping space, a bathroom, and cooking facilities, it can potentially qualify as that second residence.
So the interest on my yacht mortgage could be deductible. Wow.
Potentially, yes.
Okay.
But there are limits on the amount of debt, of course. This is called acquisition indebtedness. For home mortgage debt taken out after December 15, 2017, and before January 1st, 2026, the interest is deductible on only up to $750,000 of debt principal.
$750,000 limit.
Right, $375,000 if married filing separately. Now, if you had debt from before that date, it's grandfathered under the older, higher limit of $1 million. And the plan is for everyone to go back to that $1 million limit after 2025. But for now, it's mostly $750K.
Okay, and what about home equity loans? People used to deduct interest on those all the time, didn't they?
They did, and that's a really important point of clarification now. Under the current rules, again from 2018 through 2025, interest on home equity debt is generally not deductible.
Oh.
Unless, and this is the key exception, the loan proceeds were used to buy, build, or substantially improve the home that secures the loan.
Ah, so if you used a home equity loan to, say, add a new room or remodel the kitchen, that interest might still count towards the $750,000 limit.
Exactly. But if you used it to pay off credit cards or buy a car, then nope, that interest is not deductible currently. This catches a lot of people by surprise.
Yeah, I bet. What about points you sometimes pay when you get a mortgage? Are those deductible?
Good question. Points are essentially prepaid mortgage interest. If you pay points when you purchase your main home, you can generally deduct them fully in the year you pay them.
Okay.
However, if you pay points when you refinance a mortgage, you usually have to deduct them evenly over the life of the new loan. You can't take them all up front.
Spread them out for refinancing. Got it. And prepayment penalties.
If you pay off a mortgage early and get hit with a prepayment penalty, that penalty is generally considered interest and is deductible.
Okay. And just quickly, what about investment interest?
Right. You can deduct interest paid on money you borrow to make investments, think margin interest on a brokerage account. But that deduction is limited to your net investment income for the year. So you can't deduct more investment interest than the investment income you earned. And this is an itemized deduction.
And you definitely can't deduct interest if you borrowed money to buy, like, tax-free municipal bonds, right?
Absolutely not. That's a specific restriction. No double dipping on tax benefits there.
Makes sense. Okay, let's move on to our last big category. Maximizing charitable contributions. This is an area people often feel good about, and there can be tax benefits too.
Absolutely.
So to deduct a charitable contribution, what makes it a charitable contribution?
Well, fundamentally, it needs to be a true gift. That means you need to have donative intent. You intend to give it away freely. There should be no expectation of getting something significant back in return. And critically, the gift must be made to and accepted by a qualified charitable organization.
Okay, so what if you do get something back? Like tickets to a gala dinner?
Ah, yes, the benefit received rule. If you get a benefit from your contribution, you generally have to reduce your deduction by the fair market value of that benefit. So if you donate $200 for a charity dinner ticket and the dinner itself is valued at $75, you can only deduct $125. Another example from the source material. A corporation donates $35,000 to a county agency specifically to repair a road right next to its property. Since this directly benefits the company, potentially saving them from a future assessment, they'd need to consider that benefit. It's not purely a gift if there's that kind of direct return.
Okay, that makes sense. What are some common things people think are deductible donations but actually aren't?
Oh, there are quite a few common mistakes. You cannot deduct the value of your time or services you volunteer.
Okay, no deduction for volunteering hours.
Right. Also, dues or fees paid to country clubs, lodges, or similar groups generally aren't deductible, even if they do some charitable work. Raffle tickets or bingo, nope. Tuition payments to schools, not a donation. The cost of tickets to athletic events, even college ones, usually isn't deductible, unless a portion is clearly designated as a contribution above the ticket value. Donating blood, commendable, but not deductible.
And a big one, gifts directly to individuals.
Absolutely not deductible. No matter how needy the person is, gifts directly to individuals don't count for the charitable deduction. You also can't deduct the rental value of property you let a charity use for free.
Okay, so it has to be a direct gift of cash or property to a qualified organization. Who qualifies?
It has to be a qualified domestic organization. Examples include churches, synagogues, mosques, temples. Also, most nonprofit schools, hospitals, colleges, universities. Governmental units like states or cities if the gift is for public purposes. Veterans organizations. Certain fraternal organizations if the gift is used for charitable purposes. Nonprofit cemetery companies.
Got it. But again, not gifts directly to Father Tim or Needy Ned.
Correct. Has to go to the qualified organization.
Timing is crucial in taxes. When do you get to deduct the contribution?
The deduction is taken in the year the payment is actually made. So if you mail a check, the date you put it in the mail counts. Postmark date.
Okay.
If you charge the donation on a credit card, the date of the charge counts, even if you don't pay your credit card bill until the next year.
Ah, good tip for year-end planning. And of course, the IRS wants proof, right? Record keeping.
Oh, absolutely. Record keeping is critical here. The specific documentation you need depends on the amount and type of contribution. For small cash donations, a bank record or written confirmation from the charity is usually enough. For larger donations, especially non-cash property, the requirements get stricter. You might need detailed descriptions, records of how you acquired the property, its basis, its fair market value. For donations over $500 of non-cash property, you generally need to file Form 8283. For really large donations, you might need a qualified appraisal.
So keep good records. Now, there are also limits based on your income, your AGI.
Yes, your total charitable deduction in any given year is limited to a certain percentage of your adjusted gross income. Generally, cash contributions to public charities are deductible up to 60% of your AGI. That's the highest limit.
60% for cash.
Right. For donations of capital gain property, like appreciated stock, to public charities, the limit is usually 30% of AGI. There are other limits too, like 20% or 50% depending on the type of property and whether it's going to a public charity or, say, a private foundation. The maximum overall deduction you can take for all charitable contributions combined in 1 year is capped at 60% of your AGI.
Okay, that's complex. What happens if your donations exceed those limits in 1 year?
That's a great feature. You don't necessarily lose the deduction. Contributions that exceed the AGI limits in the current year can generally be carried forward and deducted over the next 5 years.
5-year carryover. Nice.
Yeah, subject to the AGI limits in those future years, of course. It allows you to eventually get the benefit from very large donations.
And you mentioned different types of property. Ordinary income property versus capital gain property. What's the difference in deduction?
Right. This is important for non-cash donations. If you donate ordinary income property, think inventory from a business or stock you've held for a year or less, your deduction is usually limited to your tax basis in the property, often what you paid for it, or its fair market value, whichever is less.
Okay, usually the lower amount.
Usually. But if you donate capital gain property like stocks, bonds, or real estate you've held for more than a year that have appreciated in value, you generally get to deduct the full fair market value at the time of the donation.
So donating appreciated stock can be very tax efficient. You avoid paying capital gains tax on the appreciation and potentially get a full market value deduction.
Exactly. It's often a much better strategy than selling the stock first and then donating the cash, especially for donations to public charities. There are some exceptions, like if the property is tangible personal property used by the charity for an unrelated purpose, or if donated to certain private foundations. But the general rule is fair market value for appreciated long-term capital gain property.
Good to know. And wasn't there a temporary higher limit specifically for cash donations recently?
Yes, that's the temporary 60% AGI ceiling for cash donations to public charities. Congress put that in place from 2018 through 2025. Normally, the cash limit was 50%, so this higher 60% limit was intended to encourage more cash giving, especially when other deductions like SALT were capped.
Got it. Okay, let's wrap up by quickly touching on a few other, maybe less common itemized deductions, and then get into some smart planning tips. What else falls into this other category?
Sure, there are a few others allowed. Gambling losses, but importantly, only up to the amount of your gambling winnings reported as income. You can't deduct net gambling losses.
Solely up to winnings, okay.
Impairment-related work expenses for individuals with disabilities, federal estate tax paid on income that was also included in a decedent's estate, called income in respect of a decedent, repayment of amounts under a claim of right. If the repayment is over $3,000, this happens if you had to pay back income you previously reported, and the unrecovered investment in an annuity contract when the annuitant dies.
Okay, a bit specific there. Now, a crucial point of clarification, because this changed, and many people still ask. What about things like unreimbursed employee business expenses or fees for tax preparation?
Yeah, this is vital to understand for the current tax landscape. Those types of expenses, which used to be called miscellaneous itemized deductions and were subject to a 2% of EGI floor, are currently suspended.
Suspended, meaning not deductible at all.
Correct. From 2018 through 2025, you cannot deduct unreimbursed employee business expenses, tax prep fees, investment advisory fees, union dues, work uniforms, etc. as itemized deductions. That deduction is gone, at least temporarily.
Wow, that's a big change for many employees and investors. Okay, so putting all this together, what are some practical strategic timing and planning tips people can use?
Well, this is where you can really make these rules work for you, especially if your total itemized deductions are hovering right around the standard deduction amount. You can strategically time the payment of certain deductible items. For example, you could prepay your state estimated taxes due in January in December instead, or make next year's planned charitable donations in December.
How would you do that?
To bunched deductions. By pulling deductions into one year, you might significantly exceed the standard deduction in that year, allowing you to itemize and get a larger benefit. Then in the following year, when you have fewer deductions, you just take the standard deduction. You alternate.
Bunching deductions. Clever. Can you give an example?
Sure. Think of Cheryl, who has predictable but significant medical expenses each year. If she knows a large bill is coming due early next year, she might try to pay it late this year instead, assuming it pushes her over the 7.5% AGI threshold and helps her itemize this year. Or vice versa, delay payment if next year looks better for itemizing. Or consider William, who unexpectedly wins the lottery. He now has very high AGI for 1 year. He might choose that year to make a very large donation to his church, maximizing the tax benefit of the deduction against his unusually high income thanks to the higher AGI percentage limits.
Timing it with income spikes. Makes sense. And what about that two residences rule for mortgage interest? How could someone like Michaela, with homes in Georgia and San Francisco plus a yacht, use that strategically?
Right. Michaela has her principal residence in Georgia.
Yeah.
Then she has two other potential residences, the SF townhouse and the yacht, assuming it has living quarters. She gets to choose which one of those other two she wants to designate as her second residence for the mortgage interest deduction each year.
So she'd pick the one with the higher interest.
Exactly. She'd look at the interest paid on the SF townhouse mortgage and the yacht mortgage, see which one is higher, up to the $750,000 debt limit overall for acquisition debt, and designate that one as her second residence on her tax return to maximize her deduction. She can potentially change that designation year to year.
Smart. Okay. Finally, for employees stuck with work-related expenses now that the miscellaneous deduction is suspended, there's any way around that?
Yes, there's a really important strategy here. If you incur legitimate business expenses for your job, the best approach is to get your employer to reimburse you under an accountable plan.
Accountable plan. What's that?
It's basically an IRS-approved reimbursement arrangement. It requires you to adequately account for your expenses, like submitting receipts, and return any excess reimbursement within a reasonable time. If your employer uses an accountable plan, the reimbursement is not counted as income to you, and the employer gets to deduct the expense. It completely bypasses the need for you to try and deduct it on your personal return, effectively solving the suspended deduction problem.
So talk to your employer about setting up an accountable plan.
Absolutely. It's the cleanest way to handle employee business expenses right now.
Wow. Okay. We have really covered a lot of ground today. From the sometimes tricky rules for medical expenses and the SALT-TAM drama for taxes to the specifics of mortgage interest even on boats and the strategies for charitable giving. Understanding these nuances and planning opportunities can truly make a difference in your overall financial picture, can it?
It really can. And if we step back for just a moment, while these rules seem incredibly complex, and sometimes they are, they often reflect underlying policy goals. The tax code is frequently used to incentivize certain behaviors Congress wants to encourage. Think about it. Deductions for home mortgage interest encourage homeownership. Deductions for charity encourage giving. HSAs encourage saving for healthcare. Understanding these incentives isn't just about, saving a few bucks on your tax bill. It's about making informed financial decisions that align with your own values and your long-term goals. So, maybe a final thought to leave people with. What other personal expenses do you think Congress perhaps should allow as deductions, and what would be the reasoning behind it? Something to ponder.
That's a great, provocative question. We certainly hope this deep dive has given all of you a clearer picture of itemized deductions as we look towards 2026, and maybe armed you with some valuable insights and strategies. Keep those questions coming. We love helping you cut through the noise and get right to the heart of what's important for your finances.